You don't live in a cash economy. Even if your wallet has bills in it, even if your bank balance says you're paid, the modern world doesn't run on money you already have. It runs on money that hasn't been created yet. That's the uncomfortable truth. And it matters right now more than most people realize. Because over the past few years, something subtle but massive has shifted. Inflation, interest rates, housing, tech layoffs, government debt, banking stress. None of these are separate stories. They're symptoms of the same system tightening its grip, a system built on credit, not cash. Most of us are taught that money is the foundation of the economy. You earn it. You save it. You spend it. End of story. But that story stopped being true a long time ago. Today, almost every major economic decision by households, corporations, and governments is driven by access to credit. Not income, not savings. Credit, mortgages, student loans, corporate bonds, government treasuries, credit cards, repo markets, interbank lending. This is the bloodstream of the modern economy. And when it flows smoothly, everything looks fine. When it doesn't, things break very quickly. To understand why, you have to start with a strange fact. Most money doesn't exist until someone borrows it. When a bank gives you a loan, it doesn't hand you existing cash from a vault. It creates new money with a keystroke. Your loan is simultaneously your debt and someone else's deposit. Money appears because credit was issued. That means the size of the economy isn't limited by how much cash exists. It's limited by how much debt the system is willing or able to support. This is powerful and dangerous because credit doesn't just fund consumption. It funds growth, expansion, innovation, real estate booms, stock buybacks, entire governments. Over time, the economy becomes dependent on every expanding credit just to stay upright. At first, it's invisible. Credit feels like progress. Homes become affordable as long as you borrow. College becomes accessible as long as you borrow. Businesses grow faster as long as they borrow. And because everyone is doing it, it feels normal. But here's the catch. Credit pulls the future into the present. Every dollar borrowed today is a claim on income tomorrow. And tomorrow's income can only be stretched so far. Eventually, the math starts to bite. Debt grows faster than wages. Interest payments grow faster than productivity. Asset prices rise because credit is cheap, not because fundamentals improved. This is where the system quietly changes character. It stops being about value creation. It becomes about balance sheet management. Who can roll their debt? Who gets refinancing? Who gets cut off? At this stage, cash is almost irrelevant. What matters is confidence, liquidity, access. This is why financial crises don't start with people running out of money. They start with lenders losing trust. In 2008, banks didn't collapse because the world ran out of cash. They collapsed because credit froze. Overnight, institutions stopped believing that the debts on their balance sheets would be honored. The money didn't disappear. It became unusable. And that's the irony. In a credit-based system, money is abundant until it suddenly isn't available to you. This is also why central banks matter so much more than most people realize. They aren't just setting interest rates. They are managing the price of time. Low rates make future money cheap. Borrowing explodes. Asset prices rise. Risk feels distant. High rates make future money expensive. Borrowing slows. Weak balance sheets crack. Suddenly, everyone cares about cash again. Watch how quickly the tone changes. When credit is easy, debt is called leverage. When credit tightens, it's called exposure. Same numbers, different mood. And here's the uncomfortable part. Modern governments are trapped inside this system too. They don't fund themselves primarily through taxes anymore. They fund themselves through bond markets. Rolling debt, issuing promises. As long as investors believe governments can service their obligations, the machine keeps running. When that belief wavers, things get tense fast. This is why markets often react before policymakers do. Credit sniffs out weakness early. It doesn't care about speeches. It cares about repayment. And it explains a strange contradiction we live with. On the surface, we're told the economy is strong. Jobs, numbers, GDP growth, stock indices. Underneath, households are stretched. Corporations are leveraged. Governments are deeply indebted. The system works, but only as long as credit keeps expanding smoothly. That's not a moral judgment. It's a structural reality. Credit is efficient. It accelerates growth. It connects savers to borrowers at scale. It builds cities and technologies that cash alone never could. But it also concentrates power. Those who controlled credit allocation don't just fund the economy, they shape Italiano. They decide which industries survive downturns, which companies get rescued, which households refinance, and which default. And most of these decisions happen far from public view in risk models, in rate committees, in overnight funding markets no one talks about. So when people argue about money, wages, prices, budgets, they're often missing the deeper game. The real question isn't how much money exists. It's who can access credit when it matters most. Because in the modern world, cash is what you use after the decision has already been made. Credit is the decision. And that leaves us with an uneasy thought. If the economy runs on promises about the future, what happens when the future can no longer carry the weight we be placed on it? That question doesn't have an easy answer, which might be exactly why we don't ask it often enough.